This topic, we are going to focus on error in valuation of inventory. And we are going to find out what are the effects should there be such an error. Hello Kitty. Don't we just all love Hello Kitty? This is the year 2013, and there was a huge Hello Kitty craze in the early part of the year. However, towards the end of the year, the craze has died down. Now, I have an ending inventory of all these that you see here. I bought it at a cost of $150 for this batch of Hello Kitties. You know, back then, in the early part of 2013, I could sell all these for $400. But lo and behold, because the craze has died down, so has the market value of these Hello Kitties. The net realizable value, and sometimes known as the market value, has gone down to below its cost of $100. Now, the prudence concept tells me, that I should not overstate my assets. In this case, my asset being inventory, and I should not overstate my profits. So how, at the end of the year, how should I value my inventory? Should it be at A, $150 or B, $100? According to the prudence concept, you should take the lower one. Hence, you would take the net realizable value of $100. Then, what is $50 called? Okay, so from a cost of $150 to $100, there is a loss of $50, and we have a special name for this loss. It is called impairment loss on inventory. Uh-oh, you made a mistake. You did not record the impairment loss. So what is the impact? On 2013's gross profit, expenses, profit for the period, current assets, total assets. Now we are going to examine them one by one. So what is the impact on 2013's gross profit? Now you see this batch of inventory here. The inventory is still with you. You haven't sold them. So if you haven't sold them, there was no sales. There was no cost of sales. So if there was no sales, there was no cost of sales for this batch of inventory, there was no GP, and so it doesn't affect 2013's GP. Then what is the impact on expenses for the year 2013? Now you are supposed to have impairment loss, which is an expense, right? But what did I say here? You did not record the impairment loss, so you didn't have an impairment loss, and that was your error. Let's check this out. With an error, you did not record the impairment loss, which is the expense. If you had record, of course, then that would be no error. Then you would have an expense of $50, which is the impairment loss. So, with the error, what have you done to expenses? You have understated your expenses. Can you see this is clearly an understatement, okay, of $50 of expenses. Then what is the impact on profit for the period 2013? Now, since expenses are understated, as we said earlier, profit will be overstated. I want you to think. Now, if there are less expenses, there'll be more profit. Less expense, more profit. So, expenses understated, profit will be naturally overstated. So what is the impact on current assets for the year 2013? Now let's check this out. If you had made the error, which means you did not record the impairment loss, then you would be looking at this. That means to say I have recorded the batch of inventory at its cost price, which is $150. However, should you have recorded the impairment loss, then you would have recorded it at net realizable value of $100. So this is wrong and this is correct. So now we are talking about the fact that we are wrong, right? So the idea is you have not recorded the impairment loss. So we'll be looking at this. Can you see clearly that your inventory is overstated? Okay, your inventory is overstated. You see, this is so tall. Should it be correct, it would have been so short. So if inventory is overstated, inventory, as we all know, is an asset. And to be more specific, it is a current asset. So therefore, current assets are overstated. So what is the impact on total assets 2013? Oh, this is really simple. Since current assets are overstated, so will total assets be overstated because current assets is a subset of total assets, isn't it? And that was 2013. And so the story continues. The year now is 2014. And all these Hello Kitties were really sold for $100, the net realizable value or the market value. Then what? Uh-oh, you made a mistake, remember? You did not record the impairment loss in 2013. So what is the impact on this year's 2014's gross profit, expenses, profit for the period, current assets, total assets? We are going to examine them one by one again. So what is the impact on gross profit 2014? Now you have this batch of goods over here. You have sold them all. All of last year's inventory, this batch, you have sold them all. Now remember, this batch of goods was valued wrongly at $150, which is the cost price, okay? You did not record the impairment loss. That's the error, right? So if there was this error, then your sales, which is 100, minus your cost of sales, which is 150, you would have technically made a gross loss of $50. Now let's take a look at this. You have an error of you made an error, so you have made a gross loss of negative $50. Now let's take a look at what happens if it is correctly entered. That means you have recorded the impairment loss in 2013. Should you have done that, your inventory now would have been 100. Okay, and so when you sell this batch of goods, your cost of sales will naturally be 100. So when that happens, your sales 100 minus cost of sales 100, you get 0. You make no gross loss. Now remember, okay, this is what happens when you make the error. Now 2014 will suffer this loss of $50. Okay, but technically speaking, if you look at it this way, if you have already recognized the this cost, okay, this extra loss that you're gonna make in 2013, then 2013 should be the one that suffers the loss, not 2014. Okay, 2013 should be the one suffering the loss since the batch came from there, right? This batch of goods came from there, so technically 2013 should suffer that loss. Okay, instead of 2014, now it is affecting the profit for 2014. So with all that said, what is the impact on gross profit 2014? GP is understated. Can you see it went below? Okay, so it is understated. If there's no error, it would have been higher. So what is the impact on expenses 2014? No, there are no expenses here, right? There's no mention of any impairment loss or anything, so there is no effect on expenses. Then what is the impact on profit for the period 2014? Now what did we say earlier? GP is understated, right? GP is actually carried forward to the profit and loss section in the income statement. And since GP is understated, so will profit be understated. Okay, because I said earlier, profit is carried forward from GP. What is the impact on current assets? What did I say? This batch is sold. Bye-bye. They're not in your inventory anymore. How can there be any effects on your current assets? So there is no effect on your current assets. Then what is the impact on total assets? This is easy, as we said earlier. Because there is no effect on current assets, there will be no effect on total assets. This last slide, I provide you the summary. Now, when impairment loss is not recorded, what is the impact? Now, you realize that it will impact across 2 years. The first year is definitely this year, okay, current year. The gross profit will have no effect. Expenses understated. Profit, current assets, total assets will all be overstated. And then we have the next year, the following year. You will see that the gross profit and the profit are understated, and the others, expenses, current assets, and total assets, there's no effect of impairment loss on these. And with this, I wrap up this subtopic on error in valuation of inventory. Thank you.